Users don't want to be limited in what they can trade. They want to trade the newest stuff on day one, and they want access to a massive universe all in one place. We think of ourselves as the next hyperliquid, the next evolution of this direction.
People talk about like hyper financialization, and people are trading meme coins on Elon tweets, and if Baron Trump has launched a meme coin or something.
Yeah. I don't know if you've ever seen like those stockbroker movies like Wolf of Wall Street, where people are like, saying like, oh, I'll buy for this, sell for that, done. It's quite literally like that still in these markets, and it's just a mess. Our ethos is making this a community-aligned platform, and I think that at the end of the day is what crypto's about.
What's your wildest dream for that?
Well, my wildest dream is to...
Hello, and welcome to the podcast, Lucas. We're stoked to have you. Today we've got Lucas from Variational, a really exciting product for traders that we're excited to dive into today. My first question, I'm gonna start off hot out of the gate. Do you think your product is prepared to compete with incumbents in the decentralized space? And then is it possible that you guys can compete with centralized incumbents down the line someday?
Yeah, for sure. I mean, it's probably the most common question I get. And before I get into that, though, thanks, Jack, for having me on. Super excited to share more about Variational. And I think this is our first like really kind of public podcast besides some Twitter spaces. So it's going to be great to, get the vision out there a little bit, including on this oft asked question. So yeah, let me dive in. I'll give you a succinct answer first, and then we can kind of unpack in any direction that you think is interesting. But to start, yeah, absolutely. I think there's a lot of room for Variational to compete both in the DEX and the SEC space. And, we break down the market and think about it in a variety of different ways, right? And I can get into like each of the verticals where we think about product differentiation. But at the end of the day, I'm going to share a little bit of story first and then kind of like three key points. On the story side, I've been in crypto trading now for 7+ years with my co-founder. I'm an engineer by training, mostly doing high frequency trading stuff. My co-founder is a quant by training. We've worked together actually for the better part of 10 years now. And in crypto, we've run a quant hedge fund doing like mid-frequency stat arb. We worked for one of the biggest broker dealers, like market makers in the space for a couple of years in senior roles. And then most recently, actually, the origin story of Variational, which I'd love to share more about later, was we were a market maker for a variety of different early stage DeFi protocols and across a ton of centralized and decentralized exchanges. And this might ring a few bells in terms of, founding teams from a couple other, really strong DEXs that we respect a lot, right? But I think this has given us like a pretty solid insight, right? We're not just like casual product guys, but we're hardcore users of pretty much every exchange out there that's been built in crypto since the really, really early days. We've seen kind of like every potential model and like way of differentiating. So the point being, when I'm going through these like key points of differentiation, that's our perspective. And we decided to jump into building a DEX in the first place, like a trading platform, mostly to solve the problems that we saw with the other platforms. So, with that said, I'm happy to dive more into the story in a bit, but I'll give you like a few kind of high level, points that we really were optimizing for when we were thinking like, where does Omni and Variational as a whole like fit into the market? And number one is actually, we think users want lower execution costs, users hate fees. And we were essentially asking ourselves a question in crypto, which is about like incentive alignment and community ownership and doing things on chain as much as possible. What are the kind of unique design angles we can take that might enable, no fees, for example, which is actually something we're able to achieve. We're just incredibly lower execution costs than other venues. I can get into that in the future, how we do that, but that's like key point one. Number two is, I think one of the big things we're seeing in the cycle right now with pumped up fun and meme coins and token launches all over the place is users don't want to be limited in what they can trade. They want to trade the newest stuff on day one, and they want access to a massive universe all in one place. So that was another design goal for us that I'd say isn't really met by the majority, if not almost all other popular exchanges and trading platforms, is we want to list, an order of magnitude larger tradable universe. And number three is, and this is perhaps the obvious example, is users like yield in DeFi, right? They want real sources of yield, not just that are based on like points and airdrops and incentives, but
Right.
Yield that's coming from actual sustainable and understandable sources. And we think, our design that we've built there is able to hit all three. So in sum, right, like when we compare it to others, we built Omni to have zero trading fees, as opposed to pretty much every other platform I'm familiar with has a pretty substantial fee and execution cost, especially the centralized exchanges, which we can get to later. We support like thousands of listings, right? So that's, I'd say the average exchange has up to 100, but many of the biggest ones have, well under that, especially that are liquid. And that's its own set of challenges, both in terms of like data and infrastructure, as well as just making them liquid from day one. which again, I can get to. I like to talk. And number three is we have a community market maker that anyone can deposit funds into. And this rings a little bit to the tune of like Hyperliquid's HLP, right? GMX's GLP, Jupes, JLP, and many others. But we use a pretty unique design here. I'd say it's kind of like the next step, the next big evolution of this in a much more complex design. But this gives a really interesting source of native yield on the platform. So, our goal is for Omni to be like a one-stop shop, right? We want people to come there to trade majors with better execution costs, new and tiny tokens that you can't trade anywhere else. Exotic markets, again, don't think that's really offered by any other platform right now. Or simply deposit USDC for yield. So those are the kind of areas that I'm most excited about.
Excellent. So that's a great rundown and a bit of a rundown on the project itself. But let's back up a little bit. So like, what is Variational? Explain to a TradFi guy or something, like from the highest level.
Yeah. Let's start at the absolute highest level, which is, to clarify, Variational is a protocol, right? So it's a set of infrastructure, it's rails that we can build applications on. And particularly, it's rails to trade, settle, and clear any derivative. Actually, it runs bilaterally. So I can get back to the technical details, but at the end of the day, it's the infrastructure that allows us to build trading applications and platforms on top of it. And it's a set of systems, smart contracts, oracles, all this fancy math behind pricing and indices and liquidation. So that's kind of the baseline. The product that we're mostly focused on right now, and we'll be talking a lot about on this call, is called Omni, right? So Variational Omni is an application for retail perps trading that's built on top of the Variational protocol. And Omni is what we were just discussing. It's essentially a front-end interface. You can log into it with your wallet of choice, any EVM-compatible wallet. Most people would use something like MetaMask, right? And you can deposit some funds, some USDC, and go. And the goal is to make that as simple as possible.
Excellent. And then to touch on a couple of kind of like the characteristics of the product itself, the first one is that you mentioned was kind of no fees. So how is that possible? In a trading venue, every other platform relies on fees, but you guys don't. How does that work?
Yeah, let's talk about fees, and even above fees, let's talk about like execution costs, right? In general, there's a few components here. Like if I hop onto Coinbase and I want to market order, which is the most, kind of easy order type most retail traders would be using to just buy some Bitcoin, buy some ETH, or, any of your favorite market. Generally speaking, I'm going to have two types: a fee or a commission, right? Which is usually some percentage of my order value, right? Maybe 10 basis points, maybe 50 basis points, which is a fancy term for, part of a percentage, right? So 50 basis points is half of 1%. And then, that's charged against the notional value of my order. So if my order is, $100 or $1,000, like, this is relatively small, but they add up very quickly over time. It just tracks the amount of trading volume that you have, right? The other side of the equation is called slippage, right? There's a lot of definitions of slippage, but broadly speaking, it's when you're crossing the order book, right? The bid-ask spread, right? So slippage comes from crossing the spread. And this is essentially related to how efficient like the pricing of that market is, right? So if it's a very inefficient asset, there's not a lot of people buying and selling, not a lot of market makers on there, crossing the spread will be very expensive. So when I think about execution cost, which is essentially like, what am I paying to enter a position? Because as a retail trader, putting that cap on, I just want exposure to this thing, but I want to minimize my fees, minimize essentially that I'm starting down, say, having paid this commission or having paid this spread. These are the two things that we can, kind of change. And I'll just give you like one kind of quick example using Coinbase's most recent kind of fee tiers. We published a little blog on this, I think probably a week or two ago, where there's a 60 basis point taker fee. If you did a $5,000 take order, right, so buying like a moderate to moderately large amount of, say, Bitcoin or ETH or something like that, you're paying $30 in fees, not even accounting for the spread, just right out the gate. And on Omni, our design goal was to have that trade cost zero, right? So that's just kind of setting the stage. I know that's not your exact question. Like, the question is, and I think this is the real big thing, right? Like, how is this possible? It sounds a little bit too good to be true. And the real answer is because we use a very different design than other exchanges that have order books, right? So most exchanges that you're familiar with, centralized side like a Coinbase or a Binance or a Bybit, on the decentralized side like a Hyperliquid or a Drift or many others, pick your favorite. The vast majority of them use an order book, right? So market makers that are completely external to the platform post orders in the order book, and then when you're trading, you're filling against that order book. So the fee is actually the only way for the platform to make money. External market makers are the ones making money off the spread. Remember, we talked about the two components of execution costs, and the platforms are left to make money off of like some type of commission. In our case, all trades on Omni are against the Omni liquidity provider, which is our community-owned liquidity provision or market-making vault, right? So because we have this kind of captive flow here, we have everyone always facing OLP, the spread revenue is always going to OLP, right? And that's the key component, how OLP generates revenue at all, but it doesn't leave the system, right? It doesn't go to a third-party market maker. I won't name names, but pick your favorite that's very active or perhaps hated on even on crypto Twitter, right? Rather than leaving the platform to these third parties, the spread as an execution cost is captured and given back to OLP, benefiting our depositors. So two really interesting things happen here. Number one, there's not a really perverse incentive for OLP to necessarily maximize that spread, right? OLP is built to help the platform provide liquidity and grow, and its profits go back to the community, the vault depositors. So rather than extracting, right, OLP is able to, kind of optimize this balance of, protecting itself and providing yield for the depositors, but not taking too much out of the system, being a good experience for the takers, the users on Omni. On the other side is, the very succinct answer to your question to get to the point is OLP pays the protocol like a small, essentially volume-based usage fee that comes out of OLP's spread revenue. So we do away with fee revenue entirely. We minimize the spreads such that OLP still has a reasonable yield, but that we don't want to create perverse incentives against the takers on our platform, and that's community owned. And then there's a small amount of that that's paid back to the protocol. So the combination of these two things is that Omni is able to have no fees, and in our experience, or at least what we're designing towards, lower overall execution costs, so a tighter spread as well versus the order books that you'd see on most other platforms.
Right. When I asked what your kind of competitive advantages are in the space, that was one of the first things you said. Maybe the first thing you said is this kind of like no fee structure. However, you brought up Coinbase, right? Who they're often kind of criticized for having high fees. And I can think of a bunch of other platforms that have really arguably high fees if we compare them to maybe the TradFi world. You have like Photon charging, over 1 or multiple percents, I think. MoonPay and Moonshot have kind of come onto the scene, and they charge like obscene fees for onboarding.
Over 100
essentially.
basis points sometimes. Yeah.
Yeah. So, we exist in this kind of highly speculative environment where it kind of feels like the retail trader maybe isn't actually that sensitive to fees. And you guys are coming in and saying our competitive advantage is not having fees, or one of them is not having fees. How do you kind of like rectify that?
Yeah, I mean, I'd argue firstly, I think it's a lack of education. And I think in some cases, without, sounding too combative, but this is exploitative of retail traders, right? And I think this is really part of our ethos. You might see it in, how we're structuring our token design. I can get to that later. How we're giving, the OLP yield back to community depositors rather than having that be some shadow market making vault or internally controlled or controlled by our investors, right? Our ethos is making this a community aligned platform. And I think that at the end of the day is what crypto's about, right? Like that's what we see some of the most successful crypto protocols. I'll use like Uniswap and others as an example, right? Disregarding some of the intricacies around MEV extraction. But broadly, I think the directionality of this is making things more open, right? Giving more opportunities back to the community and doing less extraction or kind of essentially, let's call it like rent-seeking behavior or fee-seeking behavior from like third-party platforms. So that's directionally how I think about it. Now, to your question around, is the average retail trader sensitive to fees? I think it depends on the retail trader you're talking about as well. Some of the platforms you mentioned, I think their most famous function is actually the fiat to crypto like on-ramp, right? Like I think about a Coinbase, at least for US users, which are not a target market of this platform, to be clear currently. But broadly speaking, like I think a lot of people use Coinbase because they can deposit from their bank account or from Apple Pay or something like that, from their credit card, and get up and go. And I think one of the things we're seeing in the last year and a half is more crypto native adoption and penetration, right? If we look at geographies outside the US, we have large number of people where they have wallet holdings in USDC, maybe on Ethereum mainnet, maybe in Arbitrum, maybe Solana as well is increasing penetration. And I think about these as like crypto native users. The value proposition of platforms like a MoonPay or Coinbase is much lower. And then at that point, I think especially, and this is another thing that we see with kind of the market moving more towards meme coins and early launches and these types of things, pumped up fun. There's a big segment of the market that I think is, let's just say, trading quite frequently, whether it's for financial speculation or for entertainment. So these fees are adding up, and I think people are indeed starting to notice. So when I think about this, I think it's partially education. I think it's partially rent-seeking behavior by some of these platforms that have kind of captive audiences from, say, fiat to crypto on-ramps, which are becoming less relevant as the future becomes just more on-chain natively for many of our users. And finally, I think at the end of the day, for us, it's an ethos as much as a product feature. It's one of 3 or 4 things that I generally highlight. But I think for like a day trader, a momentum trader, people who are active, these are things that are highly sensitive to. For an average trader, I want to help educate them why they should care about, as I said, just a $5,000 taker order. Not that that's a tiny amount of capital, but it's something that I could foresee many retail traders being in the ballpark of. $30 in fees is a substantial amount, and that's on a single order. So that's something I want to go around trumpeting.
Mm-hmm. Yeah, it's funny too. Like, I go out to lunch or something, and I'm like, I'm not ordering the $30 entree, no way. And then on chain, for some reason, I'm like not sensitive to $100 of slippage or some high fee for onboarding or something. So
I'll give you like another quick example if I can, right? Like I think this was a big shift in retail like equities trading, just to use kind of a more TradFi example, right? Schwab and a couple others were the original low fee brokerage houses, right? And at the beginning, this was a little bit more of a fringe movement. I think some people used Schwab because they were sensitive to fees, so they liked the ethos of a no fee trading platform. But it wasn't necessarily that Schwab came out onto the market, or a couple others, right, and just decimated everyone eventually, like initially. But eventually, and it didn't even take that long, this kind of competition on fees caused everything to move towards zero or no fees. And then we also saw, trading platforms like Robinhood take this to the next level, right? Where they're offering an incredibly easy to use zero fee trading experience on, equities, on your phone, on options and everything else. And I think like ethos wise or design wise, that's kind of the parallel that we see. I don't think going around and trumpeting zero fees is going to be the only reason that someone initially uses Omni. Some traders might, but not every single retail trader. But it's going to be the combination of that community incentive alignment, easy to use platform that really makes it a compelling offering. So I guess in summary, there's lots of different reasons why we can see people initially trading on Omni, but I want fees to never be a reason why you leave Omni, right? I want you to be on there to trade like a meme coin and then say, hey, this is amazing. I'm also like noticing such an improvement in my execution costs. I'm going to trade my majors here too. I'm going to tell my friends about it. Like that's kind of the flywheel that I'm thinking more about.
You brought up meme coins, and that's something I would love to get in because they've kind of dominated the narrative of the last year. So first we have the dynamic of pump.fun, and it feels like a lot of maybe the energy that has previously in crypto been around trading perps, derivatives, has gone to pump.fun. And then second of all, you guys have a unique component to your platform, which is this like long tail of assets, these meme coins that you guys can trade on this platform. So I'd like for you to talk about like this phenomenon. Why are meme coins becoming this thing? How do you guys address them? And then is Pump Fund kind of pulling from derivatives platforms?
Yeah, I mean, lots of things to unpack there. Maybe let's start with the ongoing kind of like meme coin or speculative trend in these like small cap assets in general. I think there's a few drivers for this. Number one is I think the majors have become a little bit more stagnant and sucked a lot of the air out of the room for mid caps and like other kind of emerging tokens. So in a world where a few years ago there was a lot of volatility on just say like a top 20 or 30 by market cap coin, and trading that with leverage at 2 to 3x was like providing a lot of portfolio volatility, like a lot of opportunity for big wins. I think something that's kind of captivated the retail mindset with Pump Fun is these stories of 100x, 1000x in a few days, and also just frankly in a similar way to some of the NFT communities and others, like it's in the name, right? But it's just fun. I think people genuinely are returning to a time in crypto when there was like fun in punting on ICOs, and there was fun in trading NFTs and showing them off to your friends and so on. And I see a lot of like different reasons for that, but broadly speaking, there's an undeniable market shift away from trading majors and towards kind of this long tail. And I think your implicit question is like, in a world where these are quite volatile, like do we still need perps on them? And I'll give you a kind of a few answers to that. Number one is I think it would be very interesting to be able to short some of these. That's one broadly. I wouldn't name names, but I think there's kind of like a natural market dynamic where there needs to be some amount of pricing in people who want to take the other side. People want to bet against baskets or collections or single projects when they go crazy. And when you're just trading spot markets, right, meaning like just swapping in and out using pump or something, there's no real way to short, right? You have to borrow it from someone else to sell it short, and that's something that there's not great infrastructure for right now. I think a few people are trying, but the cleanest way is to trade derivatives. Number two is capital efficiency. Even when you're talking about these assets that are relatively volatile on their own, and it's also what makes them hard to list and hard to make liquid. We've solved some really hard problems in being able to handle long tail trading. But I think broadly speaking, like if you're a retail trader, you're still very sensitive to the amount that you deposit on a single platform. Like how many positions can I take off of that? Or, can I take some leverage? Not necessarily to just amplify my returns, but even just to be more capital efficient, or maybe I want to speculate on 2 or 3 things at once, but I wouldn't have, capital to swap into them at the same time. I mean, at the end of the day, this does come down to leverage, but I don't think it's necessarily mentally something people are always just using as a multiplier on strict returns on like a single position. And lastly, in terms of them taking away from derivatives trading, like I kind of covered that at the beginning, but I think it's a different ethos, right? It's a return to form in a way of like, having crypto as having some fun, right? Seeking like these extreme, outcomes in certain instances, right? I wouldn't say everyone trades on pump or meme coins in general for that reason. But I also think it is a real trend, right? Not away from perps, but I just say away from perps on the majors, right? And the main reason for that, again, is I just think as those become more and more institutionalized, more and more TradFi, as we see ETFs and mature options markets on them and so on, like volatility will likely continue to go down. So this means that for those traders who are looking to day trade or speculate on certain markets, I think there's a big world out there for them to trade longer down the tail.
Right. And it's hard to imagine, we've obviously experienced this kind of meme bubble, but it's hard to imagine that lasts forever. And kind of like directionally, memes are really, up, right? And if we imagine that bubble kind of deflates, then you can kind of picture a world in which people are trying to bet directionally against meme coins. And we've seen a lot of kind of bear market traders emerge during bear markets when they do happen.
Yeah, absolutely. I mean, I think we can touch on this more if of interest, but I also want to mention when we built Variational Protocol as a whole, Edward and I actually came from many years before this, including at Variational doing nonlinear derivatives, right? So things like, options and structured products. And we built the protocol to support any type of derivative. So part of our future vision, if you go look at some of the things we've released on the website, talks about, Pro, which is our RFQ trading platform for institutions to trade these fancy products. The point being that we built it in such a general way that we can support really novel types of markets. And I think this is relevant to retail as well. When you talk about like bear markets or people looking to bet against not just individual assets, but maybe sectors or maybe hedge part of their portfolio if they're really up, but feeling a little bit nervous about even the current state of the market today or bears, right? Like, I think this is like kind of answers the question, why derivatives, right? We can build, say, like basket perps that index like a basket of different pumped up fund tokens, and maybe you could short that. Or maybe you can capture like funding rate and other sources of real yield, for some of our more advanced users. Obviously, these are the things that drive the yield of Athena and many others. So like, I think there's a lot of reasons why this opens up more activity, and it is strictly, in my view, good for the market, right? It's better to have an efficient place to trade all these things. And that's really, again, like it comes from our own desire after, being crypto market makers and prop traders for a very long time. To have a platform to trade all these things. So we think our thesis is there's a lot more people like that out there.
So you guys are very unique as a platform in the fact that you guys kind of offer long tail and exotic assets. And we don't see a lot of other platforms offer, these types of assets to trade on, especially like derivatives platforms. Why is this, and how are you guys able to accomplish this?
Yeah, it's a great question. And I'll try to give you a relatively understandable explanation, because the reality is there's a lot of really hairy engineering and quant problems that come from listing long tail assets. And the short answer of why other platforms don't do it is because it's very difficult, and many of them weren't designed with this in mind. That's the very abbreviated answer. The slightly longer answer is two of the hardest things about listing kind of the long tail of markets, and even frankly like mid cap assets as well, is liquidity and counterparty risk or risk isolation, right? So I'll start with the first, which is if you go look at I won't name names, but a few other platforms that I'd say have attempted even something close to a couple hundred listings. By the time you get outside of the majors like a Bitcoin, ETH, and the Solana, etc., you're going to start to see very, very thin order books. And what that essentially means is there's not many people buying and selling this at a given time. And there's certainly not many market making firms that are willing to like quote to give a price. And this really kneecaps the market, right? Because for like a new listing, like let's say a new pump.phone token just dropped and it just kind of graduated and it's all the rage. It takes some time for market makers to pick it up, for them wanting to like figure out their pricing algorithms, figure out how to take the risk, etc., and for the exchanges to go through in many cases like their process of listing it, right? And even when they do that and all these things are hit, in my experience, these order books can still be quite thin. So this creates like a negative feedback loop where the order books are thin, so the execution costs would be huge, right? We're talking like 5 to 10% cost when you're entering a position in some cases, or there's just like no volume, right? You can execute $5 to get long or short on something like this, but I can't do any amount of a reasonable position size. So this is it's like a false start problem, right? It's like a social media platform with no posts and no users. No one's going to hop on there and start trading and start generating that volume that you need to kind of get that cycle started. So the answer to number one is you need to build a system to bootstrap liquidity, to make these things liquid from that first instant that you list them. And that's one of the design goals and the reasons why we built this Omni liquidity provider. Everyone on Omni trades against Omni liquidity provider. An Omni liquidity provider quotes across every single market on platform that we list, and it tries its best to aggregate liquidity from the entirety of the rest of the market to make it as liquid as we possibly can. Right, so this is a key point that makes Omni, in many cases, the most liquid place to trade, especially these long tail listings. And other platforms just don't have that. They don't have a liquidity provider that's built to quote on those, or if they do, it uses a very different design that doesn't provide the same depth that we can achieve. The second piece here, go ahead.
So I see kind of one problem with this dynamic, and that's okay. If I can go, leverage long on a super small market cap asset. Then and I have this kind of like passive liquidity provider that is taking the other side of the trade, and then these meme coins, as they do explode, doesn't that totally wreck the liquidity provision?
It would if we weren't smart, but we've taken a lot of care to be smart about that. And I think that is the moat, right? That's the engineering difficulty. That's why this is hard. I can't just wave my hand and quote on like a linear curve, like an AMM style, like say, GMX's GLP, or just not hedge, right? Like many of these other designs of liquidity provision vaults like don't hedge at all. That's not possible when we're talking about meme coins. That's not possible when we're talking about things that can 100x or 1000x. So OLP, or the liquidity provider, has all sorts of complexity behind it. It doesn't just quote on a linear curve. It's running a full market making strategy to provide a bid and an ask, and that spread on some of these teeny weeny coins might be large, at least definitely much larger than like a Bitcoin, but it will still be, our goal is to still be the most efficient place possible to trade in the market. Number two is OLP does hedge, right? So it can hedge on external venues. That can be on the spot markets, that can be on other linear markets. It can be using sophisticated algorithms sometimes to do what we call a basket hedge, which means even if I can't short this one asset, maybe I could short another asset that's highly correlated to it. And the final safeguard, and just to be clear here, I don't want to oversell, we're not miracle workers in the sense that if, let's just say, something just graduated, like or was just launched on an AMM on, say, Radium, and it maybe has, 5 mil in LP capital there, it's highly unlikely that we're going to be able to support, say, like 100 mil of a single directional, long position, leverage long, to use a crazy number. There's just no reasonable way for us to take on that risk or hedge it unless there were some extenuating market conditions. But we do some really interesting things with the design. For example, we built the funding rates such that they essentially will attract other takers to take the other side of that, amongst many other things. So the goal is always to provide the absolute most liquidity that we possibly can, but it's not to take unlimited or unbounded risk on some of these things. So we smart, we hedge, and in some cases we have risk controls in there that, of course, like if the numbers are insanely different, would eventually start widening out the quotes or stop them entirely.
We've seen a host of really successful DEX products pop up Some have been short-lived, some have been successful. Right now, like the primary narrative and the one that is dominating attention is Hyperliquid. Can you talk about how you plan to compete with Hyperliquid and some of the kind of like architectural differences or differences in approach that you guys have from them?
Yeah, absolutely. I mean, firstly, we've been early users and lovers of Hyperliquid for a very long time. Really respect their team. I think they did a lot of things right in the space, and definitely a lot of things right by their community with how they approach their airdrop and their token structuring and everything else. So in a lot of ways, Hyperliquid is a project for us to learn from and to respect and hold up the community. But at the same time, I'd say the designs of Omni and Hyperliquid are quite different, right? So, firstly, from a protocol level perspective, Variational is meant to be a generalized platform for derivatives trading, right? So, the types of apps we're thinking about building, starting with Omni for retail perps, but moving to institutional RFQ, and then, in the longer term, thinking about things like yield vaults and other things, is a constrained and different direction from essentially becoming, its own L1, which is where, Hyperliquid has started to move. I think it's a really exciting direction for them, but at least narratively, even for the protocol itself, those are very different, right? So I think that makes intuitive sense. When we talk about the trading product as well, quite different, right? Both are places where you can go trade perps, but Hyperliquid, in my view, has a few key differentiators from us that make it, suitable, say, to a different audience, or in many cases, I think, will be a better place to trade. Number one, as I was saying earlier, with respect to fees and execution costs, Hyperliquid is an order book based design, right? So Hyperliquid does have fees and it does rely on external market makers with the addition of HLP, but I'll get to that in a second, to provide liquidity on their platform. They famously didn't necessarily provide sweetheart deals to some of these external market makers, but it's still very much user provided liquidity there. And Hyperliquid definitely has not, at least in my experience so far, been to focus so much on this like mid to long tail listings and particularly liquidity for mid to long tail listings. I think part of their initial narrative was essentially beat Binance and Bybit as a better place to trade Bitcoin and ETH and like the majors. And I think they've very much succeeded at that. But one of the key pieces of their narrative that we thought was really inspirational was their community alignment, right? Both with how they structured their token and their product, but also in general how they thought about like building HLP and making HLP a source of yield in an open depository vault. So we think of ourselves in certain ways as, the next Hyperliquid, right? Like the next evolution of this direction, like intense community alignment, no fees, right? Redirect all the spread revenue into OLP. OLP, as opposed to Hyperliquid's liquidity provider, HLP, doesn't just quote only on platform and like hedge only on platform. It hedges externally. It uses much more sophisticated, to my knowledge, quoting algorithms, which is what's required to list like these super long tail. And we focus on like this, relatively different subset of users in terms of, having this like, key focus on execution costs and also listing new products. I think the types or the universe of assets that you want to trade on Variational is one of the key like initial differentiators. Other than that, I mean, to also call a spade, Variational is a newer protocol. It uses a different design, as I said, that we see as a superset or an evolution of Hyperliquid's functionality. And we're also, we're not even to our public mainnet yet, but we're still pre-points, pre-token launch, pre-everything else. So I think there's, kind of a lot of room for us to continue to pivot and, well, not pivot the product entirely, but continue to improve and further differentiate ourselves. But there's a lot of value in our early community members right now who are saying like, hey, we've been trading on Hyperliquid and we really want this feature to be able to trade this market or to see this like difference. And we're building a lot in that direction. Does that answer your question?
Absolutely. You touched a little bit on token here, and I would love to hear more about that. So you mentioned a couple of things: points, program, community alignment, token. Obviously, all of these have been hot button issues recently. Can you talk about the plan for like the token at all?
Yeah, I'll share a few notes here, and I'll mention that we intentionally provide a little bit of limited details on this as of right now. On our roadmap, we have it for Q2 to provide like a much more fulsome details. As we go through, structuring and planning with legal and everything else, there's certain pieces here that are still very much in motion. But directionally, there's a few things that are guiding us. Number one, and this is similar to Hyperliquid, I think it's one of the things they did right or did the best, is we want to be very community aligned, right? So you see this in our OLP design, right, where the yield of the vault's just being given directly back out to the community. You see it in the protocol design, right, where we're doing no fees, and also, most of this pricing and everything else is fair and transparent through APIs or on chain. But you also see this in how we're designing, or kind of contemplating designing our points program, our future rewards, airdrops, and even the token program. We've reserved 50% of the token for community programs, right? So this could be volume incentives, points, etc. This is like the point where we haven't like exactly doled those out. But our goal is we want there to be a large focus of like the community being a part of our success. I think a cycle that we saw in the last say year and a half was this kind of low float high FDV meta. And to explain that a little bit, it essentially just means trying to run up the valuation of your token, as much as humanly possible before you launch it, right? And launch a very late stage token at like multi-billion-dollar FDV on say a Binance launch pool or something like that. And I think this just was relatively exploitative, to put it quite bluntly. We would rather launch a token relatively on the early side. There's a lot of moving pieces there, and I don't want to give a date, but we're hoping to do it for this year, actually, on the earlier side of our roadmap. But it's our goal to launch the token early, to put a lot of the tokens and a lot of these incentives in the hands of our users, right, so that they're aligned with us. And I think that creates an amazing feedback loop where between Omni being a fair place to trade, where you can transparently see the system that's giving you the quotes, you can see its revenue, there's no fees, between OLP being a great source of yield that we're giving back to the community really, and between the token having a pretty fair distribution schedule where we're giving a good percent of it to the community and helping to align their interests, and launching it not years and years down the line when we're at a 5 or 10 billion FDV, but rather on the slightly earlier side so they can grow with us and provide feedback. These are kind of how we think about that.
Right. I think there's one notable difference with you and Hyperliquid, and this is the idea of like VC backing. And I think it's part of the criticism of these low float, high FDV coins. You guys are VC backed. Talk to me about why you guys chose that direction if you are purporting to be kind of like so democratic and community oriented with distribution.
Yeah, I mean, I don't necessarily think VC backing is antithetical to community and distribution. In a way, like we think about that as the same as the team bucket, right? It takes a team, and the team will keep a certain part of the tokens to incentivize them building the protocol and continuing to maintain it, as they do in every project, right? And in a similar way, like investor capital, for most projects at least, is a necessary way to get that off the ground. The set of investors we have, the vast majority of them are publicly listed. I think they're reputable investors and well known in the space. It's token dynamics is something I personally chatted about with most of them. I think many of them are supportive of our position to provide a large majority of kind of this alignment to our community, to our users, rather than kind of keep it some secret, say, cabal, et cetera, et cetera. Mm-hmm. And we've been very careful to select who I think are long-term partners, right? So when we have conversations, and this was years and years ago, about like who's coming on to the cap table, one of the questions was like, can we build this in the long term, or is this something that they have a shorter dated time horizon on and they're looking to make a quick buck and then exit? Everyone who's on the current cap table, is very much aligned with that vision, and I had that conversation where they want to be here for the long term. And I think that's the ethos and reputation I would hope of the investors that are publicly available there, right? Like these are guys who are well known for backing technology and technology oriented founders and being there for the long term. So I guess that's a short answer, but perhaps a little interesting wrinkle here in the story is Variational's seed round was actually raised late in 2021, early 2022. We announced it recently after we decided to pivot and build our own consumer-facing application because it became important for us to establish that brand presence. But we actually raised this back in the days when we were a prop trading firm. So that was an interesting wrinkle. I wouldn't necessarily, for the reasons I just mentioned, say that I would think it's like impossible to raise VC capital and be community aligned still. We can still do all the right things by our community, by our team, by our investors, and I think those can all be aligned with the right design as we're doing. But we made the decision to take on investors a long time ago when we had a different set of goals, and we, as I said at the beginning, were really inspired to build in the DeFi space, just seeing the problems that we ran into as we were a prop shop on our own. So I think it's an interesting kind of like little wrinkle to the story, as we didn't, decide that 6 months or a year ago. We decided that many years ago now.
Right. Interesting. Yeah, and that's a great answer as well. Plus, I think we've seen VCs even talking about how like distribution is fair, and VCs are obviously here to capture like the massive upside, and I think the extractive VCs that are getting 20% back at the TGE are the ones that kind of like ruin the massive upside for people who are kind of maybe long term or trying to be more long term and tech aligned. Another question around incentives. You talk about some practices, like this idea of democratic, finance, community alignment, all of these ideals that kind of crypto has as an industry. Sometimes I feel like these are almost antithetical to like to good business, right? Where it's like if my user is willing to pay a fee or something, why am I not extracting the fee from the user? And does that reflect on the token? Do you think it's possible that kind of like this open source, world where everything is, decentralized and beautiful and no one's taking any fees, is that bad for like the business alignment of a particular project?
I think you just have to be very careful with incentives. But to be entirely honest, this is why I say Hyperliquid is a great point of like comparison or education for us. I think, nominally, whether it's on this VC piece, but even just more broadly, how they, structured their airdrop, their token, their incentives, like their vesting schedule for the team, and many other things. They could have chosen to be vastly more exploitative than they were. And what it turned out is that doing right by the community will do right by you. And I think that's been one of the big lessons, like coming out of the side of this low float, high FDV, cycle, this more extractive and exploitative, whether it's by investors or founding teams or anything else. Obviously, I would never say we kind of subscribe to that. I wouldn't say our investors did either, but we certainly saw it in the industry. And our goal is very much to be on the other side of that. And I think it's that classic adage of like, would you rather have a smaller slice of a bigger pie? I think we can make the pie bigger here, in terms of the value of the protocol, in terms of like the value that we're providing to our users, and in terms of our future growth. Like I think we can optimize for that if we're doing right by our users and aligning incentives with them. And I wouldn't necessarily say, democratic and some of the words you use are certainly fair, and like I think they're good to describe lots of crypto. But one of the key ones I would use when we're talking about our protocol is aligned, right? Like our goal is to align and make it very clear like where the incentives are and align the incentives with our users. And like again, I know I'm beating a dead horse, but to talk about like OLP, for example, right? Like the yield here is indeed like essentially like it's the other side of the takers, right? So when takers are crossing a spread or losing money, OLP is making money, right? And you might say, hey, wait a second, like that sounds a little suspicious, but that's just going straight back to the community, to the depositors, and that's all open data on chain, right? So this I don't necessarily think is like bad business. I think it's this goes to your earlier question about the importance of having low fees, the importance of transparency. I think one of the lessons we're starting to see, and we'd like to help lead this push, is that higher transparency, lower fees, lower rent-seeking behavior, and just in general like more alignment of incentives with users, like it creates a bigger user base. Our hope is that these are things that cause us to grow and cause people to get excited about Variational. And at the end of the day, I'd rather us and our investors and others like own a smaller piece of a bigger pie that's well aligned, rather than owning 90% of a token and dumping like after a pump or something on the heads of retail. Like that's not the goal here. And I also think, frankly, people have wisened up after a year or two of that, and it was sad to see that occurring so much. But we want to build kind of for the long term for sure.
Phenomenal. We're kind of chatting on the heels of your recent beta launch for Omni, the retail-oriented trading platform. But you've mentioned a couple times that Variational is much more than that. Can you talk to me about some of the products in development?
Yeah, for sure. So firstly, I'll make it clear, like the Variational protocol is live and built. It's behind what's powering Omni. But right now, as you mentioned, we're focusing on marketing and just like all of our efforts on growing Omni, which is our retail-facing, perps trading platform. I think the reason for that is, we see huge retail demand for what we're building. I give those reasons at the beginning, low fees, like, wider listings universe, and providing some native source of yield. And we think that's the best way to bootstrap protocol growth. But the protocol actually, just to give a little bit of history, and stick with me here, I don't want to get too muddled, But as I was mentioning at the beginning, like Ed and I's background for many years was in prop trading and market making. And actually, for a while, our core focus was on nonlinear derivative, right? So like altcoin options, options on majors, a little bit of structured products, and thinking through like these more sophisticated, more like institutional facing products. I'm personally, at least currently thinking that retail likes to trade simple instruments. They want to trade perps. Perps are easy to understand. They're linear and they're very pervasive in the market. But longer term, we also saw the same massive gaps, in institutional trading as well, in how, let's say, like a large market making firm, writes an option for a large hedge fund or brokerage firm. These things are usually done completely manually. They're negotiated over like Telegram or chats. I don't know if you've ever seen like the stockbroker movies, like Wolf of Wall Street, or maybe like The Big Short's a better comparable, where people are like, saying like, oh, I'll buy for this, sell for that, done. It's quite literally like that still in these markets. And they're very manual, right? Like these institutional trades, like for options and structured products, it's like my ops guy will talk with your ops guy and like settle up, maybe send a bank wire or something, and you're doing it over email like 1 and 2 days after the fact, and signing these complex legal agreements called ISDAs. It's just a mess, right? So, part of our view, to give you a direct answer, is the thing we're building after Omni, which is actually primarily done in terms of engineering. We just are focusing our efforts as a small team on, getting Omni off the ground first. We call Pro, and Pro is using the exact same underlying systems as Omni, but instead of being retail perps trading, it's institutional bilateral derivatives trading. So two key differences. Number one is institutions trade not always versus OLP, but against each other. So it would be like a market making firm versus, say, a hedge fund. And number two is mostly built for trading these more complex financial products like options and structured products. And, essentially solving the problems that I just mentioned, like this manual, opaque nature. I think this will be good for the market. It'll build much more flow in those types of products. But broadly, like, kind of part of my ethos goal is to eventually make this so liquid and so simple that we can offer some variants of these types of products also to retail. There's a lot of like interesting synergies between Omni and between Pro, and even some other things further down our pipeline when we think about like the same liquidity, the same variational protocol underlying all of it.
Right. As a founder, what is your ultimate ambition for Variational as a protocol? Like where, imagine yourself in 5 to 10 years, where do you see the project, the protocol, and like what's your wildest dream for that?
Well, my wildest dream is to revolutionize retail trading by making, the universe of tradable assets orders of magnitude larger than it currently is. We're already going to do that just with our existing Omni mainnet, but instead of that being 10x, I'd love for it to be 100x. We have ambitions not just to list long tail assets, but to introduce new types of markets, right? We have this unique ability to make them liquid from day one with OLP. So things like baskets, rates products. Imagine if you could speculate on like, essentially the interest rate type of curves in crypto going up or down. Maybe you could hedge like hash rates on a perp or all sorts of other things. Prediction markets have also been very interesting to us. Frankly, I think they're a little bit bursty, around like big sports or election cycles. But,
right.
These, just to give you a sense of direction, like Omni's also built, I am harping on like the protocol being general, but it's built for more than just having like a long tail listings. That can also mean novel types of products. So I'd love to be the platform that introduces long tail efficiency, right, for people to be able to trade these things, but also these other types of products to retail. I'd love to help raise awareness of fees and execution costs by being the platform that offers zero fees. I mean, not to get too down the TradFi comparison, right? But I think thinking about directionally like that discount brokerage like Schwab or Robinhood, the reasons why they wanted became so popular. And at the end of the day, they lowered fees in the market for everyone because they competed away these things. I'd love for that to kind of come true. And I'd love for Omni to be that one-stop shop, right, for people to be doing a lot of volume, especially on these new products, but even they love it so much and they love low execution costs. They trade the majors there too. But that's the slightly more competitive side of the market. And then for Pro, I mean, I'd love to, we didn't spend much time on it, but it's a world that I come from that most people aren't that familiar with, this sophisticated like institutional trading of, like a hedge fund versus a market making shop. And it's just incredible how antiquated and unsophisticated a lot of that is. And I'd love to see that move on chain. And I think that's an area where we might end up with penetration even into the TradFi market because, FX structured products or certain types of options like say Asian equities and others, like they trade still OTC just like this. Crypto derivatives aren't necessarily unique there. So there's a world where we're helping bring more institutions on chain. We're helping drive efficiencies between Omni and Pro and some of our longer term roadmap. And I think I'd love to see variational underpin a lot of the derivatives volume, not just in crypto, but in the world.
Yeah, it's interesting. People talk about like hyper financialization, and people are trading meme coins on Elon tweets, and betting on like if Baron Trump has launched a meme coin or something, right? Like there's this like
Yeah.
world of like this speculation that's becoming more and more prevalent. Like DraftKings and betting sites are part of this kind of universe where like the world is coming on the internet and it's becoming hyper financialized, and it's almost like Variational can address this entire world, and it's like infrastructure for the hyper financialization of the world on chain. And I think that's a very, very cool vision, and a more democratic one as well. So that's phenomenal, and we look forward to seeing your progress. Thanks so much, Lucas. Anything you want to plug? What can people check out? Where do you want to direct anyone who's kind of interested in the variational universe?
Yeah, absolutely. No, thanks for a really fun conversation, Jack. At the end of the day, I'm super excited. The next few months for us are going to be incredible, right? We're shipping at a breakneck pace, and right now we're in our mainnet beta, right? Which means it's invite only, it's closed, and we're slowly ramping up, the user accounts on mainnet. I direct people to join our Discord and follow our Twitter. I read the Discord every single day. Almost every member of our team does. I think there's a huge amount of access to the founding team for the feedback and bug reports and everything else that people don't realize. We're definitely there in the trenches, and I'd love to see users' feedback. But it's also the best way to be alerted when we're doing drops of access codes, and we have a waitlist there in the Discord that's important to get on in order to get that early access. Beyond that, we're hoping to welcome everyone to mainnet, latter side of this quarter or into Q2. We're currently rushing towards the full public mainnet launch as much as we possibly can. And, we touched on many of the other things coming for later in this year: points program, referrals, token, working on getting Pro out there for institutional trading. But this is just the tip of the iceberg. So we want people to join our community, Discord, Twitter, and read our blog to understand more of some of the technical concepts we touched here. And then be along for the ride with us, help give us feedback, and let's all build together.
Excellent. Well, we're looking forward to seeing the progress, and we'll be following along closely. Thanks so much, Lucas.
Awesome. Thanks, Jack.